Good afternoon, everyone. Welcome back to our monthly educational webinar. BD from Bluestone Flagship Investors. Really excited to have a great guest here, who I also like to call a friend. I've had the pleasure of knowing and working with on several different things, actually. Again, but before we start, like always, we like to kind of show our legal disclaimer to say that, Bluestone this is not an offering of any sort. It's purely educational. What we're presenting here is bringing, subject domain experts to talk about their own experiences and their own path. Please check with and consult with a legal or tax professional for any legal advice, or connect with them on a one-on-one to really learn more from them. Just a quick background about Bluestone. If you're watching this for the first time, again, we focus mainly on investment opportunities where we really look at the best deals that are out there that we like to put our own money. We apply our stringent criteria to see if this really fits our taste in terms of a risk return standpoint. We negotiate better terms with these best-in-class sponsors, and we bring it to everybody, including our own investors that like to invest alongside of us. Really excited having Madhavi here. Madhavi is the president and wealth strategist at Think Outside the Stock. Like a lot of us here, she's also not as more open to investing outside the stock, but really she's here as a fellow fund manager. We've even done due diligence on commercial real estate deals together. And she also happens to be an expert in what we call infinite banking and whole life insurance. So today she accepted our offer to come in and really educate us and really expand our insight. She's also a fellow IT tech professional, like a lot of us here, and really glad that she is going to be here with us to really kind of share her knowledge and expertise in this domain. So no further ado, Madhavi, thank you for coming on our monthly webinar and really educational. And we're really looking forward for all the insight that you're going to be providing today.
Absolutely, beautiful. First of all, thank you so much for inviting me. It's a pleasure to be on this forum, and I know how passionate you are. I think that's one thing that makes us friends, and kind of a commonality between both of us is we're just too passionate about what we do. And when we actually figured out that this is the way of thinking outside the stocks or box, whatever you call it, we couldn't resist and bring it to our own community, our own crowd, whether it's tech and in my case, the first generation immigrant. I think that's what I like about you. And, this is today's session is no less than, again, this out of the box strategy. And I would say keep an open mind. A lot of people, including me, by the way, when you hear whole life insurance, it's just some switch turns off in the brain. And it did that to me as well. If I continued doing that, and not look at it from an open mind, I wouldn't have been here sharing this with you. So I will say that. Again, thank you so much for so kindly bringing me on and inviting me to your forum. I'm looking forward to this.
Thank you. Want to share on your side?
Absolutely. I'm just going to share my screen. Let me know if you can see my screen well.
All right, we're good to go.
All right, that's good. So today we're going to talk about, I think this is my one of the most favorite topic, the infinite banking, creating your own banking system, right? Of course, Billy did my introduction a little bit here. I do commercial real estate investments, I do syndication, but this is my true passion because not many people know about it or understand it. And so I love simplifying. I think that's my superpower. I would say simplifying the education about infinite banking. Billy did his disclaimer, but yeah, 2 cents from my lawyer too, that this is not an offering. This is not an, advice, financial advice in any way. This is educational and information purpose only. Please consult your CPA, tax advisor, lawyer, or whatever your team is, financial strategy team, that before you do any strategies. And also, I'm a very numbers person, really like you, and I do use a lot of examples. So there's numbers, there's point in time kind of information in there. So keep an eye on that it's market specific. So these numbers could be completely different. And I like to create your own scenario when we meet, after the first meeting. So your numbers, real numbers will be seen there, but these are just examples only. So keep that in mind, right? So before I go ahead, I typically like to ask a question that have you implemented infinite banking and why not? And maybe BD, I'll start with you. I know a little bit of your history. But yeah, I think infinite banking is kind of a tricky, right? So I commonly hear a lot of different aspects of it. So before we go ahead, do you want to just answer your question about have you implemented infinite banking to whatever
Actually,
context you can?
yeah, early on, I've actually had a policy, and I think part of the challenge is I just didn't really know how to use it because there hasn't been so much education about how to actually use it. So
Mm-hmm.
unfortunately, even though I've had a policy and I didn't really know how to use it. From my standpoint, and we'll learn more. I'm really excited about learning more. Is it's
Yeah.
just understand all the bells and whistles that it has, and so people can really reflect back and try to understand how to really use it.
Wow,
Uh,
that's spot on, BD, because quite often I get like 3, 4 answers back, and that's one of them that they don't really understand it. It's so powerful, and if you don't understand it, you can't implement it. And once you implement, you need to understand continuously how to utilize it. So that's important, right? So number one answer is always no, I've never heard about it. And you will be surprised that at least 80% people say that no, I haven't heard about it. In real estate realm, when we go to the conferences and some people have heard about it, and they say that I haven't implemented it because I don't understand it. And then, sometimes people will come and say that, yeah, I don't understand it, first of all, but I've heard that it takes time, that it just takes time to build and utilize it. And that's what I'm passionate about, to bring that simplified education to kind of address all these aspects. Because, if you don't have enough time to implement, if you don't have, the education, and if you don't utilize it, it's literally one huge strategy out of your financial structure, which should be, by the way, your foundational strategy. That's how I feel about it. So we will talk about it. And you very kindly did my introduction, but I always talk about, you know, we got to know when we're talking to somebody, what is the person behind, what's the heart behind really who we are talking. Because, for your audience, they know you very well. Probably this is the first time they've heard about me, wondering how to pronounce my name and who's this person, right? So that's why I like to talk about me as a person, as a heart behind Think Outside the Stocks, right? So, like many, I quite often say that I have a very uncommonly common story, because in bits and pieces, we all share the stories. And, Biddy, you and me share a lot of commonality as well. So first generation immigrant, came 9,000 miles away from my birthplace, never wanted to leave my city, by the way, with 2 suitcases and few hundred converted dollars, right? So we built ourselves from scratch, me and my husband, had our first kid here, purchased a house. And then 2008 happened, when we thought that we are living an American dream. Uh, the market and the job impact, you won't believe it, BD. Me and my husband both lost our projects. In IT term, we understand that when we lose a project, within 2 weeks, if you don't find another one, you lose your job. We are on H1, we have a kid, we have a white elephant of a house in California. I'm about to give birth to my second child. I'm like literally going on maternity leave any time, and both of us lose our projects. So that was 2008 for us. And punch in a gut, real estate, we had to, the house, we changed the cities from California to Austin. That's why I ended up here. And the house we had to just let go. So that kind of, was a punch in the gut. So we rebuilt ourselves in 2008. And then again, 2015, with my personal reasons, personal health reasons, I actually have to leave my corporate 6-figure earning job with one of the top 5 consulting. You alluded to it. I worked for Deloitte, and full-fledged career, great, going great, had to just leave the career, right? So again, kind of restarted doing that. And that's when I started my financial freedom kind of in a reverse order. People typically create their W-2s, the passive incomes, partial, and then leave the job. But for me, it was everything in a reverse order. So I came across the syndication strategy. I came across the infinite banking strategy. And I came across how it works together. And I was mind blown. And when I get mind blown, I was like, okay, this is, by the way, I was super skeptical about infinite banking, and I wanted to implement syndication strategy, right? So when I'm super skeptical, I go back to my numbers, my spreadsheet, and created scenarios. And I was mind blown that, oh my God, this really works, right? And then I realized that I looked around me, my immigrant community, my tech community, even the community that I lived in had absolutely no idea about all the strategies that I was looking at, right? And that's what made me restless to start think outside the stocks. And I think it's kind of a similar story. Again, unique, common, the uncommon story. You had the same story too, right? So that's why I found it think outside the stocks. And really, I'm on a mission. I'm on a mission to change the financial trajectory of one family at a time. And I'm talking about that 2-degree change when you are going on a flight path and you change your flight path of one family at a time and they completely land somewhere else. And I look at you and you're smiling because this is you, right? This is what resonates with you. But that's what it is, to change the financial trajectory of one family at a time, that 2-degree change, that 2 change, and thousands more to go. That's my mission. That's really what I want to achieve, right? So enough about me. It's about your audience today. I think I'm not going to talk about me anymore. But typically, right, when you talk to people, passive investors, and they come up with their big problems, that BD, I have these big problems. I have probably, student debt or some other debt. There's an increasing tax liability. Every dollar I earn, more and more going to IRS. And there's a fluctuating income, probably sometimes, a spouse is working or not, and want to plan for retirement and education and all the passive income facilities that they want, right? But guess what if I tell you that this is just a scratching the surface? There's more problems, and we're going to talk about problems first, which are lurking around the surface, right? This is by far my most favorite quote, Piri. We thought we had the answers, but it was the questions. It was the questions that we had wrong. And I say that because it's not about, like we talked about, the taxes and passive income and creating that, kind of the investment options, right? That's not your problem. What if I tell you that's just the surface of the problem? We got to ask the right questions, right problems, and then solve it. So before we go to infinite banking, is it okay for you if I delve into those problems first and then talk about infinite banking? All right, so let's ask the right questions. Asking the right questions. What are your blind spots when it comes to your wealth structure, right? These are the blind spots that you didn't know that you have. The number one problem is your family. You'll be surprised, and probably their experiences that we know that family is number one that wealth destroyer, right? I like to look at numbers. I like to look at the history. I like to look at the history of our country a lot. And this is what I call them financial fathers of our country, the Vanderbilts and Rockefellers and, so all these people who earned really a lot of money, they started from scratch. And why am I talking about them? Because whoever is listening today, they are the one who have started from scratch. Most of us have. We didn't know that we're going to do so well, but we did build some wealth. So that is what they did in their generation. But what happened to their money? Vanderbilt, $200 million in that age when he passed, about billions of dollars in current net worth. His heir, Anderson Cooper, $1.5 million. Again, this is a lot of money, but billions of dollars, the seventh generation getting $1 million from it. Where did that money go? We started doing this from scratch. We are working so hard to save every dollar, invest every dollar, do the tax consequences. But what if the seventh generation after this money is gone, right? Carnegie, tremendous respect for him. 350, again, 350 million, about $1 billion, $4.8 billion. A lot of charity, tremendous respect, but he basically did the charity from his money, not from what could have creating his money, the cash flow from him, right? So that's a challenge. No known millionaires. So that money is just gone because it was donated, and it was, he built a lot of things in this country. Tremendous respect again. John D. Rockefeller, on the other hand, a lot to learn from him. $450 million when he passed, 9.6 billion in today's net worth. Probably this is an older number. It could be more right now, or the more known. 150 plus heirs. Okay. $11 billion net worth. Multi-million going to charity through the cash flow. The family is getting funded through the trust and the network, the tools and techniques that he created. But this is what we want to do. So the number one destroyer is the family, because the family, whether it's divorces or one, dividing that investment in dividing the net worth, or, the people, probably divorces or probably other, suing the family. The lot of net worth is going to get distributed by that, right? Now, your investors are very savvy. The problem number 2 I talk about is the tax leakage. And we know the Robert Kiyosaki quadrant. I'm not going to dig deeper on that. We know how the self-employed pays more higher taxes. The employee has about 30-40%. Businesses, they take their expenses first and then pay taxes, so a little bit less. But investor, on the other hand, and BD, we have seen this, that the investors actually start moving towards that 0% bucket. And it's possible. We have seen some of these tax firms, $1 million cash flow, but $0 taxes, right? So I'm not going to talk much about that, but I'm going to talk about taxes in a different manner. Again, scratching the surface. You just have to think outside the box about your problem. If you pay $40,000 in taxes this year, the loss is not $40,000. The loss is the future growth of that $40,000 that you're losing. So let's say if you earn $50,000 extra dollar and you consider 0%, 15%, 25% tax bracket, the true impact of tax that you are paying is the difference. If this is compounding at 7%, in 10 years, the difference is about 200K. So whatever taxes you're losing the future growth of it. And that's why you're losing much more money, again, outside the box, right? So that's your problem number 2. Let's talk about problem number 3. A lot of people talk about the tax-free versus tax-deferred. To save the taxes, they overfund or maximize their 401k. Very interesting, right? Your qualified accounts, right? Let's say you started your qualified account 20 years back, maximizes, right? You save taxes, great. Suppose you contributed for 25 years, say, 500K total, with total savings of taxes, even if it's like 37 bracket that you save. By the way, initially when you started paying into it, your tax bracket was the lowest. And it's even today, it's the lowest. Tomorrow is going to be higher because you're going to have higher income. Suppose that money grows in that 25 years, 3 times conservatively. I'm not even talking much, right? 3 times, $1.5 million. And now your taxes are even like the lowest bracket, 22%. That's still you're paying 313 taxes. So did you save the taxes, or did you actually defer the taxes to much more liability? Now your growth is also going to pay taxes, right? So really, if you have $1 million in your retirement account, 22% to 40% is still IRS money. And you have access to only the 70%, 60% of money. So again, you have to think outside the box about what taxes you're saving and what's your future liability. But wait, again, I like to look at the history. What about your tax bracket? Biddy, have you seen how the tax bracket has moved in this country? This is the history. I'm going to give it a pause. This is the history. These are the marginal tax bracket. This is the lowest, and this is the top tax bracket. Not too long ago, this was like 70%, right? In 80s, right? It started coming down and it's kind of stabilizing, but this is driven by the administration, right? Whoever is ruling is going to decide what this tax bracket, the IRS is going to decide what these tax brackets are. So you are literally saving money in today's tax bracket where you know what the tax bracket is, but when you retire, you don't know that tax bracket and you're saying that, oh, I'm going to save because I'm not going to take so much money out. My, living expenses are going to be less. So you're literally writing a blank check in future for that interest or whatever the IRS tax consequences are that you have no clue about, right? But wait, another different aspect of it is the Secure Act. What if you pass this money to your next generation? If it is your spouse, they have 5 years to take it out. 10 years to take it out. But if it is your heirs, your kids, they have 5 years to take it out. So they will be earning top bracket, tax bracket income. And suppose you left $1 million, they have to take 200 every single year out and possibly pay 40% or more taxes in that, right? So again, you're just basically pushing this out. So that's another problem. Now, number 5 problem, again, scratching the surface, is estate tax. And many people will say that, oh, that's not applicable to me because that's for the rich people. I will never get impacted by estate tax. Ask yourself that question. Remember what Bono said. It's the questions that we're asking wrong. It's not the solutions, right? Estate tax exemption limit currently at 13.6 million for one person. With spouse, it's probably 26, 27 million. So anything above that is going to charge 40% estate taxes, right? So you would think that, oh, I'm not going to have that kind of wealth ever. But remember, this was set by, Trump administration because he wanted to prefer that, right? And it's going to sunset in 2026, December 2027. We don't know what that limit is going to be. Probably 3.55 million. That's what we are looking at it, right? So if you're thinking it's not applicable to you, let's look at the history again. 2001, this limit was 675. Anything above that you pass to your heirs was 55%, right? 2017 is 5 million. So probably we'll go back to that. And what you're earning and what you're passing is going to have that taxes. By the way, best time to die was 2010 because that was repealed for a year. They were kind of doing some modifications. Bad news is we're not dead yet. We didn't die in 2010. So yes, we're going to have the estate tax problem. So really, can you time your death? You can time your retirement, but can you time your death? And what that limit is going to be that year? So these are the problems that, I really like to talk about. And the biggest problem, because our subject for today is infinite banking. So the biggest problem I'm going to talk about is savings. We focus so much on investing that what is my next investment going to be? What is the IRR? What is the cash flow? What is my, equity multiple? Even if you're going into rental, just looking at appreciation. How much do we focus on the savings? Where are your savings sitting in? Whether your income is, earning W-2, businesses, rental income, or even cash flow from syndication. This money, when even the cash flow, say 80% comes into your bank account, it sits in the bank account. Now, the banks actually can leverage from there and they can loan that money at least 10 times to other people, and their return on that is about 700% because they have to just pay you, say, some interest, even if it's a money market account, like 5% interest, and they can actually leverage to 10 different people the same dollar, right? So they're really utilizing your money to create that leverage and create that income from them. While your money, your savings, you're putting it towards the debt management, you're putting it towards the retirement accounts or the emergency funds. It just sits into the bank account, and everybody's very happy today that, hey, I'm getting 5% plus. By the way, Fed's cut the rate. That's good news for many. But for savings account, it's not a good news, right? And of course, you do focus on your high yield CDs, the stock portfolio, the investing. I'm not too worried about it. We're not going to talk about the diversification in the investing today, right? We're going to talk about this, the emergency funds, whether it's your emergency funds for your family, making sure, I call it a sleep well money, making sure that you have enough money for your expenses, or whether it's your business reserves, whether you have a rental property, the reserves for that property, etc. And we are going to talk about the high yield CD. So this is what the replacement we are talking about. So be very clear. When we are talking about infinite banking, it is not an investing strategy. We are talking about foundational saving strategy for your emergency fund and your high yield CD. But am I going too fast, or is this a good pace? Feel free to stop me and ask
No,
questions.
I definitely love the pace, and I definitely like how you kind of put it all into perspective in terms of, are we asking the right questions? Where are, some of the issues we face? And to think about infinite banking from a different way is like, hey, at some point, all of us have to have that 6 months or 1 year worth of savings that we have to put into it. And we don't want the money to sit idle,
Yeah,
earning, a CD, but liquidity of it, right? Not all the money that we have is going to get
absolutely.
investments. There are money that we have that's going to go into investments, but at the same time, we need to have some level of liquid. And I love how you presenting the intro into the infinite banking more from that liquid bucket actually that we can use, because we all need to have that.
Absolutely. I'm glad that this is helpful because that's what I feel that unless you understand the problem, you cannot understand the solution. If I just jump into the solution and then it just feels like, oh, it's not giving me enough returns, but it's not an investment strategy, right? So that's the beauty of it, right? So let's ask, those two questions about, okay, we kind of identified the problems, the 5 problems. We kind of identified that this is a saving strategy, not an investing strategy. So let's talk about your savings and let's ask 2 more deeper questions about your savings, right? So the first question is, where is your savings? How safe it is? What is it earning, right? So let's talk about the problems about savings, right? The first of all, your interest, right? 5.5 or 5% right now. With the Fed's change, it's going to fluctuate. Not many years ago, your banks were giving you what in 2020 is less than 1%. It was not even a percent. It was like, the inflation is like 12% and you're getting less than 1%. So your money is really eating away to inflation, right? So number one problem, it's a fluctuating interest. Right now, we probably are getting more interest. The second problem is, where does this money that you earn from interest sits into your tax bracket? It goes, the 1040 sits in the top tax bracket. That's where it's going to come out from, right? So if it is 30% bracket, that 5% if you're getting and you've applied this, 30% taxes to you, your effective rate is probably in the range of 3 to 3.5%. So you're not really earning 5.5%. You're earning because you got to pay this year that taxes, not next year, not 10 years later. This year you have to pay taxes. So it's like a business. Even your savings is like a business. Income, expense, net, right? So the net is 3 to 3.5%. What is inflation doing to it, right? The inflation has been, they're bringing it in control, which is a great news for us. It was 12%. It is about 3 to 5%. So you're getting effectively 3 to 3.5%. Inflation is taking its share on it. So are you now net positive or net negative on your savings? Right? Again, it's out
Net
of the
negative.
box.
Yeah.
Right? So
And that's what a lot of people don't understand, that when you're earning interest on your savings account, that's taxed at ordinary income level. And you're
exactly.
talking 30%. We live in California where traffic and taxes are a must have, and
I
it's closer to the 50% level.
I try to
So you're
I
being
try to be
generous
kind.
with
I
your
try to
tax
be the
estimates
kind
here.
to California and New York people. But yes, absolutely. I mean, that's already net negative even before the inflation hits, right? And then the main question is, right, the institutions, you feel comfortable because they're FDIC insured. Are these really stable institution? What happens when recession hits? What happened in 2008? What happened to even sometime the SVB, that bank failure that happened? These institutions, these are not stable. They're volatile, right? You don't know if this is going to be your institution going to be impacted in the next recession cycle. So really the first question to ask about your savings, is your savings account serving you or getting stagnant? So that's the first question, right? The second question, right, that when you have your savings account, right, it is, all the problems, the problems, the 5 blind spot we looked at, all the problems combined together, the generational wealth depletion, the tax leakages, the low or the tax growth of the interest, the insecure and volatile bank. If somebody sues you, what is the most accessible money they're going to have? The bank account is the no-brainer. It's not even equity in the house. It's not even in, I mean, of course, the brokerage is also liquid, but the bank is like the cash sitting in there. So there is no asset protection on that account, right? And when it comes to state tax, again, it's going to be a problem with that. But again, if it's sitting in the bank account, does the bank say that, hey, BD, you have 100K sitting in here. Let me offer you a protection on your life because it's sitting in there and just doing nothing. And we are actually utilizing for so many purposes and we're getting benefit from it. Are they offering you any additional benefits? They are not. So what if your savings sat in an institution where there is no tax leakages, you're getting compounded growth, your savings are growing, they're liquid, and they're providing you additional death benefit on top of it compared to what the savings are doing right now? Why would you not have it? Just because there's a stigma about the whole life insurance. I really, beginning of the meeting, I talked about be an open mind, and this is exactly what I'm talking about, right? So I think outside the stocks, it's not about just your investing and your returns in the investing, but it's about changing the perspective. It's changing from being a frog and looking around and looking at your problems and your solutions, but being an eagle, kind of change that perspective and think about beyond passive income and financial freedom for a moment and think about how you can grow, preserve, protect, and pass your generational wealth for generations to come. So that's what is going to be perspective of the infinite banking that we're going to talk about today. Okay. So let's talk about, I love Maslow's pyramid, by the way. And the reason I love it because there's a foundation, that's, you must have seen the food pyramid, etc. But really the top 1% think differently, and what, the typical middle class think differently, right? The tier one, which is the foundational asset, should be your risk-free foundation. And Biddy, you and me are in investment world. We never use words like risk-free, guaranteed, etc., right? But your foundation needs to be that risk-free, guaranteed growth. As you go up, right? And that foundation basically is protecting your emergency money and also your biggest asset, which is you. As you go up, you get more risk. You kind of have a little bit less control, but you also have your growth. So you got to do that. You create your foundation, you invest in yourself, in your business, your rental income, or probably syndications, indirect investments, speculative on top, which is probably the stock market. Many times when I look at my investors' profile, they're upside down in this. They have the speculative at the foundation. It's like a pyramid is upside down, right? So that's really, what we have. And then on the cornerstones of this of the pyramids, the four cornerstones are your life protection, your tax planning, your asset protection, and your estate planning. So that's how I look at somebody's, kind of when I said that the grow, preserve, protect, and pass your generational wealth, this is a structure that I look at from them, right? So let's talk about, for the purpose of this webinar, is the tier one, which is the foundation, which is creating your, the foundation asset, which is the infinite banking, right? Let's talk about this saving strategy that could give you guaranteed growth year after year through the recession, through the Great Depression, anything. Guaranteed growth that's better than banks, number one. Number two, this is tax-free growth as it's growing. And when we are withdrawing, you can use a leverage strategy. This is a liquid money, by the way. You can use either draw the cash out, but that's not how we recommend it. We will talk about it in a minute why. But withdraw, just like your home equity loan, withdraw using leverage so that it's tax-free when you withdraw. And then you pass it income tax-free to your next generation. Right now, you can contribute, you can create your own limit to it. It's not like a 401k that you can just put, certain amount per year. You contribute with creating your own limit. This is liquid for any use, any purpose, any age. So this can be used for your, real estate investments, your kids' education, your retirement income, or passing to the generational wealth, right? So you can literally use it for any purpose at any age. You're not tied that, okay, I have to retire, be a certain age to access this money. You can decide that I want to retire at 55 and you can access this money. This provides automatic asset protection in many states. Okay. And this also passes income tax free, not estate tax free, but income tax free. Your 401k, your qualified accounts is not passed income tax free. This is passed as income tax free to the next generation. But imagine this institution, we do it with the institution which has never lost money, even in 150 years. And I'm talking about literally like the world wars and Great Depression and, all the 2008 that we have seen, and even through COVID, never lost that money, right? So that's what the benefit of it. And most importantly, it protects your biggest asset. That's you. So these are all the advantages of the infinite banking system, right? So let's open up that curtain. Are you ready for that, Biddy? We talked enough about the problems. We talked about, what the advantages are. Let's talk about straight up what infinite banking is, right? Infinite banking, and every word that I'm saying is very, very important. It's not your ordinary whole life insurance. It's not. It's not your index life universal at all. Okay. It's a whole life product with mutual companies, properly structured. So not just any whole life product with mutual company, properly structured. Cannot emphasize enough about properly structured. This has to generate, consistent dividend. So this company needs to have the dividend history. So the way it works is that we create a structure for you. It generates that cash value over the period of years, starting the first year. It gets dividend because of there's a cash value in there from the insurance companies, because now you're a policy holder. It's almost like you are a business partner in that small percent with this huge mutual companies, and they're providing you dividend every year, not interest, dividend. And then you overfund this cash value so that you get more dividend every year from them. So she's kind of abusing that dividend getting ability from it, right? And while you're doing that, now remember the life insurance is the basis that we are utilizing it, right? The life insurance has the word life in it, but it's tied to the death benefit. People like us, we would have thought about that. Okay, this is the money that I will never see. But actually, now you can utilize your life insurance during your life. You can live your life insurance, use the cash value for any purpose, for any age. It's an easy access. And hey, on top of it, it protects your life too, which is you are your biggest asset, right? So that's the beauty of it. But quite often we hear that, hey, life insurance, I've heard that buy term and invest the rest. So I'm gonna, if you're okay, I'm gonna talk about that. And remember what we talked about, changing the perspective, being an eagle and looking at things a little bit differently. This is think outside the stocks. It's not just the outside the stocks, but it's the outside box perspective I have always had my life, looking at same things differently, right? So let's talk about different assets, right? Now you have BD, there's real estate asset, there's, syndication, many assets that you have created over the period of time. What is your biggest asset? Let me talk about that. You are you're the chicken who's giving the golden eggs. And everybody's listening today, that's what it is. You are your biggest asset because you're the chicken that's really laying the golden eggs for your family, right? So let's consider, let me prove it to you. Let's consider a moderate person, 40 years of age, 150 income, retirement age is 65, so it's going to work for 25 years. Say the income grows 3% conservatively every year, and he or she has a savings of 100K, which is growing 6% compounded. And every year, 6% of the income is being saved. So very conservative, right? What do you think the income potential of this person is? Give me a number. What do you think, how much income in that 25 years this person is going to bring to his family's life?
Gross earned income?
Yeah, this 25 years, how much money as an income and how much money as a growth of that savings that he has will see. Just a number, just a random number. Doesn't have to be correct.
3 million.
You close. 5 million is the potential. And most of these people I see, they will have just a term life policy, mostly with the companies, not even outside, about $1 million. If you're going to create $5 million income and you're just protecting yourself for $1 million term life, that's going to go away. You're not protecting your family enough. By the way, that savings, that including the income and the savings, it's 10 million potential. So you not being in your family's life is you taking away this human life potential away. So we got to protect your human life potential. That's number one. That's the perspective that you need to bring it. So, right. So now, again, going back to buy term and invest the rest. Let's look at it from your home perspective, right? If you are renting and you're like, oh, renting is so cheaper, I don't have to ever purchase the house. You will have cheaper rent, $0 equity over the period of, say, 30 years, 600K out of pocket. That's less money than the home, right? You purchase your first home, say a starter home. I don't even know it's going to be 225K anymore. It could be like 400K, but let's consider, right? You pay mortgage and interest, you out of pocket some money, say about 350K that you paid, but you have 550 equity. So that's the equity after 30 years, you're completely owning free and clear, right? So that's your first home, but you could also do a second home, which is your luxury home, like $1 million home, a 750K home. You will pay over the period of 30 years, a little more than $1 million in it. And it has appreciated to say close to $2 million. After 30 years, you're going to have free and clear 2 million because you all paid into it. Principal interest is gone, right? The infinite banking is very similar. The term is corresponding to the rent, that even if you get $2,000 per term per year, 30 years, that's $60K 200K out of pocket, that's zero cash value. That's money down the drain. Your first home is, I will say, a typical whole life policy, not infinite banking, a whole life policy, which is probably 7,000 year, 24 years, about 150K out of the pocket, and it builds in that years about 200K plus cash value. So that's kind of your first home. Your infinite banking is now that kind of a luxury home where you overfund it. So instead of 6,000, 7,000, you put 20,000. So compared to 2,000 in term, you're putting 20,000, but 20,000 is not expense. You're putting your money as cash sitting in there, which is earning compounded growth. So for 24 years, it can have a $500,000 out of pocket, but about a double than that, $1.2 million cash value sitting in here. So compared to the home, but wait, when you had the home, you actually had to pay taxes and insurance on it. There is no expenses here. And when it has $1.2 million cash value, it has more death benefit, maybe $2 million plus more death benefit that you can pass to next generation. So now tell me, would you buy term and invest rest, or would you actually put it into the infinite banking, right? So again, just reiterating, guaranteed growth better than banks, tax-free growth with withdrawals, with leverage, contribute without limit, liquid for any purpose, any age, automatic asset protection in most states, income tax free to the next generation, 150 plus years, never lost money even during the Great Depression, and it protects your biggest asset, and that's you, right? So that's the benefit. But now on top of it, if I tell you that you can actually use this money at two different places, and this is very interesting for real estate investors. Now imagine if you saved 100K in your bank account and the syndication comes up and you take the 100K out, put it into syndication. How much money do you have in your savings account? $0. In case of infinite banking, if that same investment comes in, you're gonna borrow from it. So you actually borrow from, say, life insurance company or somebody else, pay the simple interest, say 6% interest on it. You borrow it. This is never stopped growing because this is compounding. The money did not deplete to zero. There's still 100K in it. Same 100K, you put it into investment at a small cost of that simple interest. And say if you're getting that 16% return, costing you 6%. So now you're getting 10% extra and you're getting a compounded growth inside as well. So your same dollar is growing at two different places. This is all the benefits that I showed you, all of these benefits, compounding growth, tax-free growth, and access anytime. And it's also creating your investment strategy. So it's called an and asset. And above and beyond all this benefit that I just told you, this is one of the like a benefit on the steroids that you can utilize the same dollar at two different places. And I can take a pause here if you have a question.
I do actually, because this is probably the most interesting part for me is when we had our side chat about a month ago in Dallas. But the beauty here is just like you have to put money into a savings account, it is growing, and you don't have to worry about ordinary income tax because the rate of return in that policy is growing, and you don't have to deal with it. The cash value is growing. At some point, what you're saying is you can collateralize your cash value in your policy, and you take a loan against it. Now, when you take a
Yes.
loan against it, there's going to be a cost of capital, right? Cost to borrow, whatever it is. But as long as you're deploying the money in an investment, it's bring you higher than your cost to borrow. If your cost to borrow is 6 and you're putting it into investments bring you 10, you're already netting plus 4% on that. But
Absolutely.
your original investment, which is the 100,000 cash value, is still compounded, continue to compound. So it's not even stopping. So on one part, your cash value is growing inside the insurance policy, and at the same time, your borrowed money that you took is actually growing because you're having a spread between what you're borrowing at and when your outside
Absolutely.
investment is generating for you. That is actually, for me, that's really marvelous, like beauty right there.
Absolutely. And that's the mind-blowing fact about it, that the money never came out. And again, I like to compare with the home. So consider your home. Suppose you started that 250K home, which became $1 million after 20 years. To access that home equity, you create a line of credit. The money comes out from the bank's pocket. It's not your pocket. You don't have to sell the home be homeless to access that equity, because the moment you sell, you're gonna get the tax consequences for it, right? So same strategy, you leverage from it. You'd say that, hey, I'm taking a loan. Do you pay taxes on the loan? You don't. You're paying, and you only take leverage when it's worth it. If something is giving you outside, 6% interest, like your banks are giving, and your after tax, whatever is coming down to 3% to you, and this is growing inside, say 5% or more, why would you take it out, right? So this is compounding tax free till the money is inside. It's not going to get taxed, right? And when you want to withdraw from it, you can withdraw till the money that you contributed, that's basis, tax free. And beyond that, you can take a loan from it. By the way, Biddy, this loan, if you don't pay it throughout your life, and say if you have a $2 million death benefit and $1 million loan outstanding, which you have invested in different places, your death benefit is 2 million minus 1 million is 1 million is what's going to get passed income tax free to your heirs. So you're not passing your liabilities of these loans to your heir. That's very, very important. And, people, I never liked loans. It felt like a pressure on my head. But if you utilize leverage for a right thing and right strategy without passing the liability to your heir, why would you not do that? Again,
I love
that's
it.
that's the change in perspective, right? So again, love the history. I like to look at who has used this kind of strategy, right? The whole life, the cash value. We talked about John D. Rockefeller. Did you know that Walt Disney, when actually had a dream of creating a theme park in that time, how many banks do you think would believe on that dream that did not know what theme park is, and nobody did? So he went back to his life insurance, he went back to his home equity loans and pulled out a lot of money. And that's what, the happiest place on the earth actually is funded by this money. Jesse Penny, 1929, during the super stock market crash, had no money to pay his payroll. He actually went back because that did not deplete. It does not deplete. It's a guaranteed growth. It does not go down. It's not your IUL, by the way. IUL can go down, but this does not go down. It just goes up, up. So if your growth is, if you started with 100K, it becomes 500K, your 500K is protected. If it becomes 700K, your 700K is protected. So this is the history that people have used even during the one of the hardest times, like Great Depression, that the system that they have created within the infinite banking. So another quick recap. I don't know how are we good on the time? Do you want me to go a few more minutes? Otherwise, I'll jump
Sure,
to
we can
the.
go a few more minutes and maybe have a bit of dialogue, some
Absolutely,
Q&A.
absolutely. So, just real quickly, this is a compounding interest principle. Compounding interest is uninterrupted, right? Typical savers, we save, we spend either in expenses or getting income or, rental, etc. If we have a capacity to put $1,000 away, growing 6% compounded for 30 years, it can reach $1 million. Compound interest is the eighth wonder, as Einstein says. One who understands it earns it, one who doesn't pays for it. So we want to be the paying side. So this is what simplified the infinite banking strategy will be for you. You're funding and putting it inside. It's growing compounded, and yes, life will happen. You will have expenses. You will have, investments or education expenses, travel expenses here. You're going to borrow from it and pay it back, borrow from it, pay it back as a discipline. Even if you don't pay it back, the death benefit takes care of it. And that's why, my friend, this uninterrupted compounding without touching, this has to happen till the day you die. And this is what is going to grow that tremendous growth. It's about borrowing others' money and have that uninterrupted growth. So really, when it comes to real estate investment, for example, typically when you have savings account and you have that money sitting in there, you put the down payment, you take a bank loan. But in this case, you're going to take a loan for that down payment as well. So you're 100% leverage. So your rate of return here on 100% leverage is what you can calculate, right? So this is how you utilize it. And then the inside money is collateralized. So it's still growing compounded. So it's borrow, not withdraw. Have your money do the two jobs at the same time. So that's really how the AND asset is, that you build the policy cash value whether it's expenses, you utilize it, whether it's, your investments, you utilize it and you keep on refilling and utilizing. So that's the beauty. And that's what the and asset is. So simply what's next is, you can jump on a call with me. We will get to know about your goals and objectives, how you want to utilize it. Everybody's different. I'm an independent broker. I can do different companies based on your need. Then we create that structure. Again, mutual companies, whole life policy, dividend paying, very, very important. We max fund it. You received your guaranteed growth, which is 3.5% guaranteed plus the dividend. Current dividend with one of the companies is, 5.75%. You grow without disturbing. You borrow from any time that you want to do it, any kind of fund, and repeat. And that's essentially, what the infinite banking is. So I'm just gonna offer that free strategy session for your people if they want to just point at that and schedule a session with me.
Wonderful.
So with that, yeah, I'll take some questions from you.
No, absolutely. So again, from a big picture perspective, a lot of benefits that we see here. Some people, for example, might not be insurable. They've had a health bump along the way. It's too expensive for them to insure. They might not qualify to get insurance. Is there a way for them to continue to have such a product by maybe insuring somebody else, whether it's their spouse or their children, and yet still, yeah.
Yep, such a great question. And you kind of alluded to the answer already. I'm not insurable. I do it for the world, but I'm not insurable, right? So the challenge is that when you don't have the health, because, people ask me what are the, what is the other side of the coin? The other side of the coin is that this is tied to your health and your age. With your age, we can still adjust something, but it's tied to the health. And once your health is at the point where that you can't do anything about it, then you can utilize it, this structure, on your spouse, which probably will be healthier. You can even do it on your kids. Rockefeller family I was talking about, whenever there's a new baby is born, they create the first day the policy on them, right? So you can create on your kids. Remember, there are two different purposes that we are trying to achieve. This one is protect your human life value, and second, to create this compounded growth year after year uninterrupted, right? So that you can utilize and actually do it for, somebody else. So whether your kids going to have a better kind of a actual table when it comes to insurance. Your spouse might be healthier than you. So yeah, definitely that's exactly how I did it for my family. And that's how I utilize it for many, many people as well. So I actually have this was just scratching the surface about internet banking, by the way. I actually have a master class where I go dig deeper into the numbers and kind of explain some scenarios. So if somebody wants to have that access to that master class, I think, there's a link as well there. So yeah.
No, that's wonderful. I appreciate all the value that you're providing here for a lot of our audience, and definitely giving them the value of a master class to really understand this a little bit further. From my understanding, there's a lot of people like to overfund this type of policy, right, in order to start getting the benefit of the cash value, growing the cash value, where they start with a larger lump sum to start with. There are situations when they encounter what's called MEC, modified endowable contract. So can you maybe touch a little bit on that in terms of like, where do you see that really happening? And I know it's a bigger topic, but it's probably
It
one
is,
of the
but it's a
questions I
great
have.
question. It's a great question because I always love the history again, BD. I'm just going to answer the history first and I'm going to answer your question. So why did even MEC came in picture, right? So everything that I showed you, right? You pay the taxes on your money, you put it into infinite banking, it's growing year after year compounded, you borrow from it. Did you pay taxes on it? You didn't. You passed this to generational wealth. Did they pay income taxes on it? They didn't. So guess who didn't like this structure? That once they pay taxes, they will never ever pay taxes on it. So IRS didn't like this structure. So right. So in 1980s, actually, rich and wealthy understood the benefit of this whole life, and they can overfund it and create that compounded growth and pass that to the next generation. So this is the only one rule that actually IRS has. This is the only one kind of a take. Otherwise, this is insurance companies ground. This is so massive that IRS has no say in it, but they just had their way. And that's the only thing that they did, is that they said that, hey, when you're putting in money it has to be proportionate to the death benefit that you have, right? So you can't say, I want to create $1 million policy and put like 500, 800K in it, and which is compounding and growing. And that's the reason. So again, understanding the reason behind it is important, right? So the MEC limit is modified endowment contract. If it crosses that limit, it's gonna get taxed. So that's a simplified version of it, right? So if it
Right.
crosses that limit, whatever dollar that's coming out, whether it's loan or whether it's you're pulling the cash value out, is gonna be taxed. So
Right.
as a as your helper, my intention is that you don't cross that, right? So when I'm creating that structure, again, when I say that, I insist on that structure is so important, because if that doesn't get created and that you cross that, make all these benefits of tax advantage just go away. And actually some people don't care about it, and that's actually is their strategy, that they overfund it, they cross that make limit, but they're never going to take out that money in their lifetime, and the income tax free debt benefit still passes, right? So there is actually advantage of crossing the make limit, because then now you can overfund it and get the advantage of that compounding, and if you don't ever need that money during your lifetime, right? So there's advantage of making it make, but most of the times my clients, when I structure it, that make limit should not be touched. So there is like a 7 pay limit that, somebody will come and say, for example, that, hey, I have 100K sitting here. Can I just push it 1 year and not push it anything next year? So that's where the challenge is. The way it needs to be structured, that if it is paid 100K first year, then it needs to have at least for 7 years the death benefit that is proportionate to that. So if the 100K goes in, and suppose that death benefit is say $3 million or $2 million, then they need to have that $2 million death benefit at least for 7 years. So the next year, if you pay just say 20,000 in it, it's not efficient. I mean, you can do it still, but it's not efficient for you. So that's when I'm creating that structure. I'm going to check that MEC limit for you, and then probably we'll just, you know, overfund it consistently for 7 years. And then after that, want to go and drop down. And there's so much flexibility in it, Biddy. And that's what I talk about, that when I create that structure based on what you need, what your goals and objectives are, whether you want to use it for your kids' education in 10 years, whether you want to keep on utilizing for real estate, whether you want your retirement that's coming up that you want to utilize it for. So that's what I keep in mind. And that's what essentially what we're going to create, keep in mind that it should not cost that back limit. Hope that
Wonderful.
understand that. Hope that.
It does, and I definitely appreciate the fact that you're a fiduciary when you're setting them and as an independent advisor, because I think that's what a lot of people don't understand coming into it, is really being able to set up the infinite banking that works for you necessarily.
Absolutely.
For the user, there's so many options to how to actually structure it. So definitely you touching on just the tidbits of this and providing a masterclass, I think will be fantastic for a lot of the audience that actually get to enjoy this. But any last thoughts or departing thoughts you'd like to kind of give
Absolutely.
to the audience? I mean, I appreciate all the great value that you provided for all of us today here in terms of educating us, or at least letting us start the rope in terms of understanding infinite banking, which is a fairly complicated
It
concept
is.
overall. But
It is.
any departing thoughts, Madhvi?
So my passion is, and first of all, again, thank you. Just enjoy teaching about it so much, and you can see that I'm so passionate about it. And that's the same passion when I want to build something, the structure for somebody, right? And simplifying this education, this complex topic. I have a lot of people that come to me and say that, hey, I have this policy, and I ask 2 questions and they can't even answer that 2 questions about it. So I want to make sure that, you understand that product where you're putting your hard-earned dollar into it. So we kind of go in hand in building this model for you and educating at the same time during this strategy calls that I structured with you. So keep that in mind, right? So why I often say that, people will hear about something, it's very, very important right then and there. What happens is that, when you actually sit on it, the next day the importance becomes 50%, the next day even 50% less, and then by within a week it becomes a 0%. So if you heard something that's going to change your financial structure significantly, which is this one has an ability to do it, the time to take action is not tomorrow, it's not even later today. The time to take action is right now, because my friend, tomorrow at least one of the two things is going to change, which is going to impact it, is one is your age or your health. So log that in right now. That is driven by it. I implemented for several people, but I cannot implement. It's painful for me to do that, to see that, and I don't want that to happen to you. So time to take action is now. Just take that one small baby step. Just jump on a call. That's my, connect call that you can jump on a call with me. And let's just start with your goals and objectives and where you want to go from there.
Wonderful. Madhavi, thank you so much for your time today and for the tremendous education here for a lot of our listeners. Please reach out for Madhavi. She's provided us a lot of value and a lot of education. And again, hopefully this was mind-opening for a lot of people. I continue to study this, and when I typically have questions, I'm going back to Madhavi for some
Absolutely.
more help. Thank you, Madhavi,
Anytime,
for your
Biddy.
time.
And I'm so grateful. Thank you so much again for inviting. You reach out anytime.
Absolutely.
Love
Thank
to.
you.
Thank you.